Today we're going to have a point-counterpoint debate on the nature of the overheating that may or may not be in place in the U.S. economy. So business leaders, policymakers, they face a confusing set of signals right now about the factors that determine the state of the economy and its nature. Those range from a stunning rebound in consumer demand, an exponential jump in COVID cases associated with the Omicron variant, pressing labor and supply shortages, and most recently, perhaps inflationary pressures that we haven't seen in decades. We had the most recent print on the CPI that was at a level we hadn't seen since 1982. And so the state of the aggregate economy, while murky, it carries really important implications for business leaders, for policymakers. And for instance, we can ask questions like, how should business leaders tasked with managing scarce resources in a complicated external environment even plan? So critically today, we're going to ask the question, is the economy seriously overheated? And do current conditions primarily reflect a transitory imbalance that's sort of likely to pass with COVID and other short-term supply chain disruptions, or something that's a bit more pervasive? And so today, we're fortunate to have our own Kenan Institute of Private Enterprise Executive Director, Greg Brown, and our Chief Economist, Gerald Cohen, to hash out this in a point-counterpoint debate. So here's our proposition. The U.S. economy is in severe danger of overheating. We'll begin with the in favor. Greg, the floor is yours.
Great, thank you, Christian. So I'm going to make the case today that not only is the economy in danger of overheating, but it's actually in the process of boiling over. That we have really reached a point where there's sort of unprecedented excess demand relative to supply in the economy. So I just want to walk through my logic on this. So as economists think about overheating, what we really mean is that when we look at the amount of consumption of goods and services that are happening in the economy, that it's really an amount that exceeds, in some sense, the economy's long-term ability to sustain that level of production. So in essence, there's kind of too much money chasing not enough goods and services. And so the kind of implication for this would be things like inflation, imbalances, and undesirable inefficiencies in the economy, things that aren't sustainable. So how do we make this case? So in essence, there's kind of two things that we need to dig into carefully. The first one is, what is the level of aggregate demand in the economy? What is that level of goods and services? And then second of all, what is the level of supply in the economy? And then where do those line up relative to each other? So what happened during the COVID recession was quite interesting. There was a huge collapse in demand, of course, as everybody went into lockdown. And there was also a huge collapse in supply as people stopped working. Right? And there was tremendous unemployment. People just weren't going to work. But what's happened since then is there's been a significant snapback in both aggregate demand and aggregate supply. So if we look at what's happened to demand, it's grown quite substantially. We've really done what people call a V-shaped recovery in terms of demand. And in fact, the level of demand, real demand, inflation-adjusted demand right now in the economy is above where it was prior to the pandemic. And that's great. We should be really happy that we didn't end up in a depression type of scenario. But where the challenge for the economy is on the supply side. So we did see a snapback in supply as people came back to work. We did see sort of interesting things happen as businesses figured out new ways of doing business that should sort of increase the productive capacity of the economy. But it didn't snap back anywhere near to where it was prior to the pandemic. We are still very, very short the number of people working in the economy that we had prior to the pandemic. And if we also think about the fact that the number of people working in the economy, the labor force tends to grow over time, there's even a larger gap between where we would have expected things to be after a couple of years and where they are now. And so in essence, there's really just two things that matter at a very aggregate level in terms of determining the supply of goods and services in the economy. It's how many hours people are working and then their output per hour or their productivity. And it's incontrovertible in my mind that the number of hours has declined. We've just seen literally millions fewer people than expected working in the economy right now. So can we make a case that productivity has grown substantially? I don't think we can. We did see productivity gains in 2020 as sort of companies figured out new ways of doing things. But over the last year, we've actually seen a slight decline in productivity. And with all the challenges that we have with things like supply chain disruptions, with people having a hard time recruiting workers, things aren't getting more productive. They're getting less productive as people have to find these workarounds. So I think that what does this mean for the current situation? What it means is that there's likely a very, very large gap between what the current level of demand is in the economy and what the current level of supply is in the economy. I estimate that this is a number that could be 5, as much as 6%, and that would be the largest gap ever since we've been collecting data on this in the post-war period. And I think the bigger concern is that, this may not get better in 2022. It may in fact get worse because we're projecting strong GDP growth again in 2022, something on the order of 4%. Whereas we think that even fairly assertive estimates of the number of people coming back into the labor force may only be a couple million, 2.5, 3 million people, which would still leave us well short of where we need to be to get supply and demand back in balance. And I think that there's other sort of ancillary knock-on things that support this case. We see the number of job openings right now relative to the number of people seeking work at a record high. We see the number of people filing unemployment insurance claims at a record low, going over a very long 50-year history, even though the size of the economy and the number of people working has grown a lot over that time period. And I think obviously inflation. So we're seeing inflation not just in goods and the things that everybody wants to buy, but we're increasingly seeing it in housing. We're seeing it in healthcare and in other services where we would worry much more about price inflation bleeding through to cause sort of a policy problem for the U.S. So with that, just making a very simple case that if we look at the actual numbers right now, where we stand in January 2022, the level of aggregate demand in the economy greatly exceeds the level of aggregate supply. And this imbalance is going to lead to some potential difficult situations going forward for both policymakers and businesses.
So that's...
The opposition is yours.
Thanks, Christian. So I think Greg actually makes a number of points which are very important, but as you dig deeper into those points, you can see why it's the inflation that we're seeing and overall aggregate demand that we're seeing may be more temporary. So let's start with aggregate demand. Yes, consumer spending has rebounded past, post-COVID levels. However, it's all come from goods. So there's been a significant shift in demand from services. So most of our spending is on services. Actually, about 80% of our spending is on services and construction, and only 20% of our spending is on goods. That increased precipitously, or had a huge gain during COVID. 20% of our spending went to almost 25%. And as Greg indicates, the manufacturing sector has had a hard time meeting that demand, both domestically and externally. You've had some special factors where where auto companies stopped producing cars, their demand for chips went down, chip makers then shifted, found other places for demand, and then suddenly, there at that point there was big, everybody was buying smart TVs, everybody was buying computers because they were at home. You needed a new monitor, you needed a Zoom camera, and so what happened? Or many people were at home, and so what happened was that then as the auto companies ramped up, or as auto demand ramped up, you saw that increase in demand for chips, and so that's why we now have these supply shortages. That's all to say that what you've seen is a big shift in demand for goods and a decline in demand since COVID for services that has not regained its footing. So one key question is, are you going to see a shift back from demand from goods to more demand for services? You're starting to see it. People are going to restaurants. People are starting to take vacations, but to a much more limited extent. And Omicron throws a wrench in that, or sand in those gears. And so as a result, we've now seen some slowdown again in services. If, as I believe, the economy reverts back post-COVID, hopefully, to a more service-based economy, some of these supply shortages are going to go away. It's going to take time for the supply shortages of chips to work through autos, to work through computers, but the chip companies are ramping up supply. So the first thing to remember is that most of the inflation is coming from the goods side. That is because of shift in demand. If you believe that it's permanent, then that becomes much more problematic. But if you believe, as I do, that it's temporary, result of COVID, then some of that should go away. Let's address the overall supply issue. So as Greg said, there are two components. One is hours, and the other is productivity of those workers. People's hours for the last 50 years have not really changed. We generally work close to 35 hours per week, or that's the average in the United States. So it's really about the labor force. The labor force has shrunk. We're 2.3 million people shorter than we were, or the labor force is 2.3 million people smaller than it was pre-COVID. And as Greg indicated, the population has grown. The civilian population of 16 and over, which could be potentially as part of the labor force, has grown by about 2.5 million. That, if you put those two numbers together, that means our participation rate, the number of people who are actually participating in the labor market, has fallen to levels that we haven't seen since the 1970s, when there was a ramp up in participation as a result of more women entering the labor force. The question is that permanent or is that temporary? There are places where we have reason to believe it's permanent. The number of people that are 55 and older, the participation rate has fallen, and it doesn't look like it's rebounding. Many of those people look like they've retired permanently. They've decided, I'm leaving the labor force. But if you look at places like women who are 35 to 44, kind of caregiving, who are caregivers, that participation rate has fallen, and also you're seeing some start to pick up, but Omicron and the evidence, the anecdotal evidence, you hear the stories of women saying, "Look, I can't go back to work because my kids are bouncing in and out of school," and especially folks who have to work in person, who tend to be lower educated, minority, members of disadvantaged communities. Those people are having a hard time getting back to work. And I think when COVID abates, and those are the folks that I think need to work, and we want them to be working. When COVID abates and childcare options and care options are much more, there's greater availability, we think that those people will come back. So I would expect to see some snapback in the labor force participation rate. And if you take Greg's numbers if you take Greg's assumption that you have a 5 or 6% output gap, if you have a modest rebound in the labor force participation rate, that number is cut roughly in half. The other part is potential growth, or how fast the productivity of the economy is growing. Greg, to get to 5 or 6%, assumes that the potential of the economy has barely grown. The evidence on productivity is that it's grown at a 1.6% rate since the beginning of COVID. And that's some acceleration from the pre-COVID level, interestingly. Yes, over the last year, productivity has fallen, but that's really because of one quarter, Q3, when the economy slowed and hours picked up because people were hired. And because productivity is a residual, that number fell, and that's why we got a year-on-year decline. The question is that going to continue? My estimate for the fourth quarter is that it won't, and that productivity will start to rebound. And if you believe that productivity has grown just 1.6%, and not then Greg's output gap goes from 5 or 6 to close to 0. So the economy, if you think that people are going to come back into the labor force, and you think relatively that productivity will grow relatively modestly, then we have essentially the economy is right where it should be, and there shouldn't be a lot of overheating. And then you can, as I said, explain the inflation more about an imbalance between supply and demand that will work out as people shift towards more supply, towards more services.
2-minute rebuttal.
So there's kind of two important points that I think counter Gerald's argument. The first one is I agree at some point we're likely to see labor force participation rates go back to where they were, but that's not where we are right now. Right now, we're in a place where we're still millions of people shy of where we thought we would be if you sort of looked at estimates, from a couple of years ago of where potential output would be. So I agree productivity could grow strongly in the future. People could come back in the labor force, but if we look at, how quickly those things could solve the problem by, say after the GFC, how quickly people came back into the labor force, it could be years before we get back to labor force participation rates that would close the gap versus what people were expecting prior to the pandemic. The other wild card in this, I think, is what is Omicron going to do? I think there's some evidence to suggest that the U.S. economy is kind of plowing through it, and demand is going to kind of hold up in the face of Omicron. And people that would have been disrupted maybe a year ago or 2 years ago prior to being vaccinated, or just because of a change in their views towards the pandemic, they're going to keep spending. So demand is going to stay strong. But Omicron has the potential to be sort of the mother of all supply disruptions, right? Omicron has not hit China yet, and it's hard to imagine they're going to be able to keep it out of China. And so we could see a much, much more severe supply disruption in 2022 than we've seen over the last 2 years, which could even cause the GDP gap to widen out because of supply constraints. So that's my 2-minute rebuttal.
And Gerald, your 2 minutes.
So I just want to be clear on what my assumptions are on the labor force participation rate. I am expecting it to rise to a level levels below what we saw well below what we saw pre COVID. So to go from 61.9% to 62.5%, and at the beginning of COVID, it was over 63%. And so, and that 62.5, we essentially haven't seen since the 1970s. So it's not like I'm saying we're having a snapback. I'm saying we're having some modest increase. Now, those 1 percentage point changes or half a percentage point seem really small. But when we're talking about a labor force of 160 million people, that can make the difference. And when we see all these supply shortages of labor, I keep scratching my head and saying, how can we, how can just a couple of million people, a couple of million is a big number, but how can that cause such a large imbalance? And the answer is that, we're a well-tuned economy. And so, we depend on people coming to work and working and, having and being productive when they work. And so if you lose 1 million people from the labor force and the demand is there, it's hard to make up. But again, a lot of that demand comes from manufacturing, from the manufacturing sector. Right now is coming in the manufacturing sector. And the question is, as a business person, if you're in the manufacturing sector, do you ramp up production to meet that future demand, or is that demand going to shift back? And so if you're a restaurant owner, do you want to start, having labor there ready to go? I know it's been hard to find labor, but trying to get people to come and work for you, or to have people on the sidelines ready when that demand ramps up. I agree, Omicron is a big uncertainty. I think it has the potential to hit demand as well as the supply side. I agree that again, from the goods perspective, China is a big question mark. But I know personally, fewer people. I know people are questioning whether they should go to restaurants again, questioning whether they should take vacation. Here at the university, we've moved to a potential hybrid model where some people are teaching in person, some people are not. So I think it's really it's uncertainty. And one of the questions that we'll get to about policy is, do you really want to be aggressive given the uncertainty that it could be hitting supply or demand?
So we have more to say about uncertainty, but let's kind of dig in on something that was an interesting subtlety that I think came out for both of you. So when we're speaking of the U.S. economy, we sort of think of it sometimes in a kind of monolithic thing, in a monolithic perspective. But in fact, the notion of a V shape perhaps is actually more of a K shape, right? So the reality is that the experience amongst different populations of Americans might have been quite varied. And I think you alluded to that a little bit in some subsets of the population. So I guess the question is the following: is there sort of an interplay between sort of the aggregate degree of overheating and at the same time how we ought to think about some of these disparities as separate considerations. I mean, how do we kind of reconcile those two things? So,
well, I think one of the benefits of a strong economy is going to be that you're going to see wage growth, and probably more likely wage growth on the lower end of the wage spectrum, which could benefit a lot of households that have been left out of the economic gains of the last few decades, largely. So there is potentially silver lining to an overheating economy. The concern is that if that translates into inflation, that disproportionately impacts these households because it's in food or energy or things where they consume a larger share of the typical consumption basket, then that could offset the gains that they would get on the wage side. So I think it's an open question in terms of what the welfare implications are for society as a whole if we have an overheating economy.
Thoughts?
So I agree with Greg. I think you do need to dig a little bit into the data and look at the fact that the people that, as I alluded to, the people that have been hurt the most are folks that are lower education levels from minority communities that have to work in person. We've been very fortunate. The three of us can move, can work virtually. For a time we taught virtually, but those workers can't. And so one question is, if you try to tighten policy, as Greg is implying you need to do, how will that affect those particular communities? I think there is some way of a happy median where, for example, the expanded tax credits were cut at the end of the year. And if we could do something like a means test where we would provide expanded tax credits to folks who are hurt and continue to be hurt by COVID, and then cut them for folks like that were able to work through COVID and have been able to find those jobs, and are able to, are getting those jobs. I agree that the rising tide of wages lifts all boats. And I think that one question that we can address is whether this wage increase is kind of a one-time shift in wages. And so you're seeing kind of the lower wage groups seeing a big lift, but not a permanent increase in wage gains, or have wage gains that are in line with the rest of the economy. Or is this a spiral where you're going to have continued wage gains? And that's something that, if that happens, or if you have a wage price spiral, I would agree that we would need to tighten, but I think the jury is out on that. And so letting some wage gains run to help those communities, putting in place policies carefully to help those communities would be really beneficial. I also think, to this question of demand, you've had a huge gain in savings. My estimate is there's about $3 trillion of excess savings. So that's not wealth. That's folks who didn't go on vacation because of COVID, and they kept that money in the bank, and that money is sitting in bank accounts, not in stock funds. And and that has been spent on boats and new cars and things like that. And one question I have is whether people will regret some of those decisions. And so you'll see kind of used cars, prices which were up 3% in December start to fall again, because people will say, well, maybe I shouldn't have spent money on that fancy new car. Maybe I'd rather go on a vacation. On the flip side, the lower income, underserved communities didn't have as much of those savings, because they don't take as many vacations, and as a result, they're not the ones that have kind of benefited from the increase in the stock market, and from they're still in the same general economic situation that they were. And so you're seeing kind of this dichotomy in demand, and the question is, can we shift that demand towards, or can we meet the needs of those kind of underserved communities in the way we set demand policy?
So let me dig in on something you mentioned there, which was the possibility of a wage price spiral. least it's a possibility. And so if we're worried about tightness in labor markets and we're worried about the extent in which firms may pass some of these costs on, I guess the question I have is almost a bit philosophical in a way, which is, do Americans really know what inflation looks like? It's been in a generation, perhaps two, since we've seen anything like what we saw in earlier times, unless you lived or worked outside of the country. And so in some sense, is our inference about these driving forces challenged by the fact that nobody really has any institutional memory? I mean, you have to be essentially over 50 to even understand what a wage price spiral really looks like. So, I mean, how do you think about that concern about like almost a digestion process and an inference problem?
Well, I think we're getting ready to find out. I mean, I think we're already seeing the early stages of wage inflation. And whether this is justified by productivity gains or not, which would make it sustainable, I think the jury's out, right? Because frankly, we just don't know what's happened to productivity, right? I mean, it's productivity because it's this residual. It's hard to measure. You don't have a good handle on what's happening to productivity over a 1 or 2 year time horizon. If businesses have found great ways to better do business more efficiently with their employees, and that justifies 4, 5, 6% wage gains, which is what we're seeing now, then that's a good thing for consumers, and they can live with that, and we should see a decline in inflationary pressures potentially, and so we'll see how people respond to that. But I think that there is going to be a bigger risk in 2022 of expectations, people's expectations about inflation driving through to wage gains than what we saw last year, for sure.
Well, thank you both. So I think while the comprehensive answer here to the question of the overheated nature of our economy, it remains elusive. I would say there's a lot of uncertainty. I think we all agree on that. I want to thank our debaters for providing a framework, at least to help us better appreciate the kind of moving pieces that are at force over here and at work. And so let me also advertise next a teaser. So in part 2 of our exchange, our next Kenan Insight, which is going to feature next week, we're going to dig deeper into the implications of this debate for policymakers, both monetary and fiscal. And critically, we're also going to explore the implications for business leaders. And perhaps we'll find some points of agreement amongst our participants. And so the business leaders are tasked with managing these scarce resources in an intellectually challenging time. And it's our job to help provide some thinking there. So thanks very much to both of you.